Hi, Daniel here. Now let's talk about interest rates. In particular, I want to talk about how interest rates fluctuations will affect you and what are the causes behind these interest rates movements. Without further ado, let us get started. Number 1. How will the interest rate fluctuations affect you? Now, to understand how will the interest rate fluctuations affect you, you have to first understand what interest rates are and why it matters. To put it simply, interest rate is essentially the price of money. It is the price that you will have to pay when you borrow money from others, and it is the price that you will receive when you lend money to others. That said, a rising interest rate is not beneficial to most of us who have a large amount of borrowing, as the price that we're paying on our housing loans and our loans in general will be higher. A higher interest rate will also cause the economy to slow down, as companies face a higher cost of borrowing, which in turn affects their bottom line. Right? Think about it. If you're a business owner and your company's operations and sales start to slow down, it will result in lower profitability. And if you're an employee and your company start to slow down, it will indirectly affect you as well in terms of things like your job progression and your job stability. That is why having an understanding of the behavior and the level of current interest rate is important, even if you're not an investor, right? Number 2, what causes the interest rates to fluctuate? Right? So what causes the interest rate to fluctuate? What causes it to go up and what causes it to go down? Generally speaking, there are 3 key factors that affects the behavior of the current prevailing interest rate. Right? The first is the supply and demand for money. The second is the inflation rate. And the third is the central bank's or the government's interest rate and inflation rates target. Right? So let's go through them one by one. The supply of and demand for money. Now the thing about pricing money or determining the interest rate is that it is not that different from trying to price your goods and services. At the end of the day, it boils down to basic economics like your demand and supply. Right? If there are more demand for money than there are in supply, interest rate will increase as people are willing to pay a higher price to secure the limited borrowings available. If there are more supply of money than there are in demand, interest rate will decrease as lenders now need to lower the price of money to attract more borrowers to borrow. Generally, to determine the future direction of interest rates, all you have to do is just to gain an understanding of what's the likely demand and supply of money in the near future. However, do take note that there are 2 types of participants in the market of money who can influence the demand and supply of money itself. Those that uses it and those that issues it. Participants that uses money are like your companies, your businesses, and ordinary consumers like you and me. Right? We need that money to facilitate our day-to-day transactions, and we cannot, by any legal means, create the money on our own. If you try to do that, you'll be sent to jail. Right? Having said that, it means that the supply from your money users is limited, but the demand from your money users is unlimited. On the other hand, the participants that issues money are participants like your central banks and governments. As money issuers, they really have no need for the money that they can easily create. And because of that, the supply from a money issuer can be unlimited. But the demand from a money issuer, it really depends on their intentions and their motivation. I'll elaborate a bit more on the point of central banks and governments later on. For now, let us move on to the next point. The second point that we're going to talk about is inflation. For the benefit for those who are new to finance, inflation is the decline of purchasing power of a given currency over time. The inflation rate is the rate that measures the extent of which your purchasing power changes, be it for the better or for the worse. The best example I can give you was that 10 years ago, Big Mac cost around $5, but now it costs around $8, and that $3 differences is what we call inflation. Essentially, if you were to measure what this inflation rate is, it stands about 60% over the last 10 years. So how does inflation rate actually affect the interest rate behavior? For you to understand how this works, you have to see things from the point of the lender. Right? Imagine now that you are going to lend your friend $100,000 today to start his business. And in exchange, your friend promises to pay you, let's just say $120,000 at the end of 5 years. which may be what you needed to buy the car that you always wanted to have. Now, before you actually agree to an interest return of 20k, you realize that the price of the car that you wanted actually increased from 120k to 130k in 5 years' time. And if that happens, you have a problem, right? If you were to lend your friend at the original interest return of 20k, you will not have enough money to offset the increase in the cost of car in 5 years' time. So what will you do? Or what can you do, right? The obvious thing for you to do is to transfer this expected increase in the cost of the car to your friend by raising the interest return from 20k to 30k. So at the end of the day, while you are able to fulfill what you originally wanted with the loan agreement, your friend now have to bear on a higher interest rate. And that's how inflation, or the expectations towards inflation, actually affects interest rates behavior. As the inflation increases, lenders will now want to be compensated for a loss of purchasing power. And as such, they will start to raise their interest rates to price in these differences. And history has shown us that there's a very high correlation between your inflation rate and interest rate, as you can see here. Moving on to the last point, which is the government's interest and inflation target rates. The third factor that could influence the interest rate is the role that government plays as part of the market participants. Recall earlier that there are only two types of market participants in the market of money: those that use it and those that issue it. And for those that issue it, like that of a central bank or government, they really have no demand for it, but they have an unlimited supply of the money they issue, right? In the case of the government's interest, when it comes to money market and interest rates, they use it as a form of instrument and as a form of tool to influence the economy and the behavior of the participants that use the very money that they print or they issue. For example, if the government would like to stimulate the economy, all they need to do is just to lower the interest rates by flooding the market with very, very cheap money, right? With an increase in the supply of money in the market, the price of money, aka your interest rates, will naturally decrease. Similarly, if a government wishes to slow down an economy, all they need to do is just to increase the interest rates by extracting money out of the system. With a decrease in the supply of money in the market, the price of money will naturally increase. This is also a reason why everybody pays a lot of attention as to what the government's target is when it comes to the interest rates, as the government have all the measures at their disposal to bend the interest rates to what they want it to be, given that they have an unlimited supply of the very money that they can issue or print, right? This is also another reason why everybody pays a lot of attention to the inflation target rate, as oftentimes inflation is seen as a measure as to how well the economy is doing at the very moment. Based on the inflation rate situation, the government will then turn their attention to the interest rates to help fulfill their original economic targets. Long story short, the interest rate is something that affects us directly via our borrowing costs and also indirectly via the economy. It will be wise for you to pay attention as to what is happening in the economy to determine whether or not you should be more aggressive or defensive about things like refinancing your loan, or maybe if you're considering to switch careers or to switch industries, is it really a wise time to do so depending on how the interest rate might affect the industry you're in? And also if you're considering to leverage to invest in things like property or annuity, right? That's all I have for this video today. In the next video next week, I will be sharing with you on my thoughts and opinions of the interest rates behavior moving into 2022. So do subscribe to the YouTube channel to stay updated with future uploads. If you found my content useful, do help me to like this video and comment in the comment section as to what topics would you like me to explain and share my opinion on next. If you wish to find out about how you could benefit from engaging in my financial planning services, you can reach out to me directly through my website or contact me via my LinkedIn. Stay safe and I hope to hear from you soon.